there's a good chance the government owes you money right now. If you've been paying higher rate income tax and contributing to a pension, and you haven't been claiming the full relief through your tax return, HMRC has been sitting on money that was legally yours. And there's a deadline on claiming it back. Here's the core of it. The SIPP, the self-invested personal pension, is one of the most powerful tools in the UK tax system. For a basic rate taxpayer, every £80 you put into a SIPP, the government adds £20. Your pension receives £100. A 25% uplift before you've made a single investment decision. For a higher rate taxpayer, that same £100 in your pension effectively costs you £60 once you've claimed what you're owed. In this video I'm going to show you exactly how that works, why it matters whether you're employed or self-employed, the rules you need to know, and the one mistake that costs higher rate taxpayers money every year without them realizing it. Here's the problem the SIPP solves. When you earn money, income tax leaves before you ever see it. At 20%, for every £100 you earn, £80 reaches your account. At 40%, only £60. At 45%, £55. By the time money reaches your bank account, it's already been taxed. And when most people invest into an ISA, a trading account, savings, they're investing money that was taxed on the way in. The SIPP changes that. With a SIPP, you contribute from your post-tax income, just like everything else. But then HMRC refunds the income tax you paid on that money directly into your pension. That's called tax relief. It's not a government bonus. It's your own money back. The logic is straightforward. HMRC doesn't want to tax money twice, once when you earn it, and again when you try to save it for retirement. That distinction matters. This isn't the government being generous. It's the government correcting for a double tax that would otherwise happen by default. Here's what the numbers look like, and the framing that makes it click. Think of it this way: to get £100 into your pension, how much do you actually pay? If you're a basic rate taxpayer, you contribute £80 to your SIPP. Your pension provider automatically claims 20% tax relief from HMRC and adds £20. Your pension receives £100. You paid £80. If you're a higher rate taxpayer, you contribute £80 to your SIPP. The provider still claims the basic 20% relief, £100 in the pension. But because you pay 40% tax, not 20%, you're owed another 20% on top. You claim that through your self-assessment return. HMRC refunds £20 directly to you. Your pension still has £100. But your net cost is £80 minus £20, that's £60 out of pocket for £100 in the pension. If you're an additional rate taxpayer at 45%, same mechanism. You contribute £80, the provider claims £20, the pension has £100. You then claim the additional 25% relief through self-assessment, HMRC returns £25 to you. Net cost, £55 for £100 in the pension. The key point, the contribution to the SIPP is always the same. What changes is how much you get back from HMRC on top. And the mistake most higher rate taxpayers make? They contribute, the basic relief goes in automatically, and they assume that's all there is. It isn't. Half the benefit requires you to claim it. Let's talk about how this applies depending on your situation, because employed and self-employed work differently. If you work for an employer, you almost certainly have a workplace pension already. Under auto-enrollment, your employer must contribute at least 3% of your qualifying earnings, and you contribute at least 5%. A minimum 8% going in, and your contributions get basic rate tax relief automatically. But here's what most employees don't realize: your workplace pension and a SIPP are completely separate accounts. You can have both. They don't compete. Why would you want a SIPP alongside a workplace pension? First, investment control. Your workplace pension gives you whatever fund choices your employer selected. Often a handful of options, sometimes just a default fund. A SIPP opens up the full market: individual shares, ETFs, index funds, bonds, rights. If you want to build a specific portfolio, you can. Second, higher rate relief. If you pay 40% tax, you claim the extra relief on your SIPP contributions through self-assessment. Some workplace pensions use salary sacrifice instead, where contributions come out before national insurance is calculated, which is even better. Worth checking what your employer offers, because salary sacrifice through a workplace scheme often beats a standalone SIPP for employed people. Third, consolidation. Most people who've had more than 2 jobs have pension pots scattered across old workplace schemes, often in poor default funds with fees they've never checked. A SIPP gives you one place to consolidate everything, with full visibility and control. The number of lost and forgotten pension pots in the UK runs into the billions, literally. If you're self-employed, you have no employer. No auto-enrollment. No one putting 3% in on your behalf. Your retirement provision is entirely your responsibility. And the numbers on this are stark. According to the Institute for Fiscal Studies, fewer than 1 in 5 self-employed people in the UK are saving into a private pension. The SIPP is the primary solution for this group. It's flexible, you're not locked into a fixed monthly contribution. You can put in £200 one month, nothing the next, and a lump sum before the end of the tax year if you've had a good year. The tax relief applies either way. For sole traders, you earn, pay income tax and national insurance, then contribute whatever you can to your SIPP. Basic rate relief goes in automatically via your provider. If you pay higher rate tax, you claim the extra through self-assessment, the same return where you declare your income. The best way to understand the SIPP is to put it next to the ISA, because they're both tax shelters, but they protect you at opposite ends of the same journey. The ISA shelters your money on the way out. You invest from money you've already paid tax on. But everything that grows inside is yours, tax-free, whenever you want it. No restriction on when you access it. The SIPP shelters your money on the way in. You get the tax back up front. Your money grows sheltered. But when you take it out in retirement, you pay income tax on most of it, as though it were income. Neither is better. They're designed for different purposes. Most people building serious wealth use both. I've covered the ISA in detail in my previous video. If you haven't seen it, the link is in the description below. Here's how SIPP withdrawal works in practice. From age 57, rising from 55 to 57 in 2028, you can access your SIPP. When you do, 25% of your total pot comes out completely tax-free, up to a lifetime limit of around £268,000. The remaining 75% is drawn as income and taxed at your rate at the time. Here's why the math still works strongly in your favor. Say you're a higher rate taxpayer contributing £500 a month into a SIPP. Over 30 years, at an average 7% annual return, that pot grows to approaching £600,000. Because of the 40% relief, your actual out-of-pocket cost was £300 a month, not £500. You built a pot approaching £600,000 on contributions that cost you £108,000 net. And the tax efficiency compounds further in retirement. If you contributed at 40% and withdraw at 20%, as most retirees do, you got relief at 40% and paid tax at 20%. That's a 20-point structural advantage on every pound that passed through the SIPP. The system is designed to reward people who use it. Here's what to actually do with this. First, know your annual allowance. You can contribute up to £60,000 per year into pensions, across all your pensions combined, or 100% of your earnings, whichever is lower. That's the limit. One quick note on something you may have read about: the lifetime allowance, which used to cap total pension savings at around £1 million, was abolished in April 2024. It no longer applies. If you've seen older articles referencing it, ignore them. And one important caveat: if you've already accessed a pension flexibly, through drawdown or a lump sum, your allowance for future contributions drops to £10,000. This is called the money purchase annual allowance. If that applies to you, take advice before contributing further. Second, understand carry forward. If you haven't used your full annual allowance in the past 3 tax years, you can carry that forward and contribute more than £60,000 this year. This is useful after a high-income year, a bonus, a good freelance year, or selling a business. You must have been a member of a registered pension scheme in those years. Use the current year's allowance first, then draw on the carried forward amount. Third, if you're a higher rate taxpayer, claim your additional relief. the basic 20% goes in automatically via your provider. But if you pay 40% tax, you need to claim the extra 20% through self-assessment. HMRC will not chase you for it. It's your responsibility to claim it. And if you've been contributing without claiming, you can go back up to 4 tax years. Check them. Fourth, know where to look if you want a SIPP. The main UK platforms differ on 3 things: fees, fund range, and simplicity. Hargreaves Lansdowne, the most widely used, with the widest choice, but higher fees at 0.45% on the first £250,000. AJ Bell, competitive fees, well regarded specifically for SIPPs. Fidelity, broad fund range at competitive prices. Vanguard, the low-cost option, a flat £4 a month on balances under £32,000, then 0.15% a year capped at £375. Limited to Vanguard's own funds, but for most long-term investors, that's all you need. Interactive Investor, flat fee, very competitive for larger pots. And Pension B, built for simplicity and for consolidating old workplace pensions. Links to all of these are in the description, and your workplace pension doesn't stop you opening any of them. For most people starting out, a global index fund is a common starting point: low cost, broad diversification, no stock picking. Do your own research, fees and fund ranges change. Fifth, understand the inheritance tax position. This is one of the most underrated advantages of a SIPP, and it's about to change, so the timing matters. Right now, your pension pot sits outside your estate for inheritance tax purposes. If you die before drawing your pension, the full pot can pass to your beneficiaries free of inheritance tax, and potentially free of income tax too, depending on your age at death. But this is changing, and it's now law, not a proposal. From April 2027, under the Finance Act 2026, unused pension funds will count as part of your estate for inheritance tax. What doesn't change? The tax relief on the way in, the sheltered growth, and the 25% tax-free lump sum. The SIPP remains one of the most tax-efficient vehicles in the UK system. But if estate planning matters to you, the rules after April 2027 are different and worth a conversation with an advisor. Sixth, think of the SIPP and ISA as a pair. The SIPP covers money locked away until 57, with the upfront tax relief. The ISA covers money you might need before that, tax-free on withdrawal. Most people building wealth over the long term use both the SIPP for the tax advantage going in, the ISA for flexibility. Quick recap. A SIPP gives you tax relief on every contribution. Basic rate is automatic, your provider claims it. Higher rate and additional rate, you claim the rest through self-assessment. Your money grows sheltered inside. At 57, 25% comes out tax-free, the rest is taxed as income, typically at a lower rate than when you contributed. If you're employed, it sits alongside your workplace pension. If you're self-employed, it's the primary vehicle. The missed higher rate relief is the most common and most fixable mistake in UK pension planning. If you've been contributing and not claiming, you can go back up to 4 tax years. Check them. One question before you go: are you employed or self-employed? Drop it in the comments below. It changes which of these approaches matters most for you, and I read every one. If this was useful, subscribe. One video. One concept. No noise. Next, ISA versus SIPP, how to actually split your money between the two, at different income levels and different life stages. Most people guess at this. The next video gives you a framework. See you there.